I've come along to the Ceres Rural Planning Your Rural Priorities seminar here at the stunning Blenheim Palace in Oxford to look at both the challenges and the opportunities that have arisen for farmers following Labour's recent budget.
And I have to start for all of the presentations in this second half with this general disclaimer that you're hearing some sort of general information. Your circumstances will be individual to you, so you must take specific advice before you make any action or inaction. Now, just trying to take some positives from the budget somewhere because the Labour cabinet, they don't have any business experience, but it would be completely wrong to say they don't know what they're doing. Quite the opposite. They're very cunning. They do know. They're very logical in holding things up against a socialist framework. So we've got that to come, for the next 4 years. But it could have been a lot worse. We still have gifting relief. We still have holdover relief. Just before the budget, I was helping a lot of clients to essentially retire early, to sell their shares in businesses or business assets, because we thought that the business asset disposal relief, the old entrepreneurs relief of 10% capital gains tax, was either going to be seriously curtailed or taken away altogether. It wasn't in the end. It goes up to 14% in 2025 and 18% in 2026. So those of you who perhaps let's wait and see, well done. You have got another 4 months now, to do some of that planning if you want to still make use of that 10% capital gains tax rate. Remember that deals involve people, and involving people takes time. So you've got some time there. The second thing that happened, and we actually knew this before the budget, was the national minimum wage going up to £12.21. Now that means that if you're employing a 21-year-old or above, the starting salary is effectively £24,000. So those of you who are running perhaps cafes or wedding businesses, that's where that will affect you. Now, the economics of that is that people at that level of salary will spend more of their extra salary, which puts the money back into the economy, which comes back to you and your cafe, wedding, etc. I'll leave it to you whether you agree with that economic analysis or not. It's obviously quite significant. The other one that's been in all of the news is the employers' national insurance. They've done two things. One is reduce the thresholds from £9,100 to £5,000, and they've also added 1.2% to the rate of employers' national insurance, which is, of course, a tax on employment. Where they've been quite clever and cunning here is they've added the employment allowance and set it at £10,500. Now, previously, only smaller businesses could take advantage of that. Now, all businesses can take advantage. So what you tend to find as a generalism, if you're a small business, they've been quite clever because that £10,000 cushions you, so you tend to sort of sit in the chair and sort of do that and think, that's a bit of money, but you tend to be okay. With this, they've gone at the big corporate businesses. The chairman of ASDA was on the radio the other day saying that this will cost them £100 million. What you can do, though, is a very simple action you can take. Your payroll system, because it has to comply with the pension legislation and real-time information, is you will be able to export your October payroll into Excel. What you can do is if you export it to Excel, use some formulas to adjust for any national minimum wage implications or what the employer's national insurance would be if it was under the new rules. Times it by 12, okay, it won't account for starters, leavers, pay rises, but that will just give you a good general ballpark of how much this measure is going to cost your business, and you can plan for that. The other one is these double cabs, a U-turn on a U-turn, an Isuzu that self-identifies as a truck, now as a car, and then back as a truck again. Now, they are going to go back to being a car. Now, this proposal was under the Conservative government as well as the Labour. What this tells us is that this is not political. There is some wonk or wonkess at the Treasury who's obviously decided that this is too much of a giveaway and they want it to go. Not a huge amount you can do about it because probably the values of these have already been depressed in the market. One thing you can do is either sell that truck to your employees or lend them money or lease them the money. What that just does is it gets the benefit in kind out of their pay, which they will likely complain about. Inheritance tax. You've got to have been living under a rock, for the last week or so, if you haven't seen that the effective rate of inheritance tax is 20% over £1 million. As Charlie, introduced, this affects small businesses. This is not just farming business because it's the business, property relief. And I think some small businesses perhaps do need to wake up on this as well. It's not just your industry. And I think, really, what do we do about that? And I think the message here is just keep calm and carry on, for the moment, because, they could have taken lifetime gifts away, or they could have extended it from 7 years to 10 years, or do whatever. There's still holdover relief, which means you can defer your capital gains tax gain. We have to wait for the draft legislation to see what it actually says. And in particular, a lot of you all have questions on trust and practical applications to trust. We've been promised a technical consultation document in early 2025. So we have to wait for both of those documents to really work out what to do. And of course, there's a lot of backlash against this, a lot of public opprobrium. So there could be a chance that Labour will actually row back on some of this. What I think we'll see here is a change in mindset. Inheritance tax has always been a tax that you plan for, you mitigate, and I think that will just continue. Some of the things I think we might see as trends that develop, earlier succession planning, via gifts. I think we're going to see a lot more of that. Is retirement or thinking about retirement 55 or 60, or is it actually 30 now? Definitely, I think there's going to be more usage of trusts. There's already anti-avoidance rules to stop you making 10 trusts with £1 million each in it. That one's gone. And of course, you've got your 3% 10-year charge. The financial planning industry has already gone into overdrive, and I think what we're going to see next year is some sort of self-administered pension schemes that will own £1 million of business assets. There's this joke about farming businesses that you have to breed your own employees because it's only your family members that will work in the business. So with that sort of joke in mind, if a lot of your staff are perhaps family members, then maybe employee ownership trusts, which have been around for a while, maybe they'll have a bit more of a role, to play in some of this. And I think we're definitely going to see a return of inheritance tax insurance, either for an untimely passing away, or if you've gone into a 7-year gift-giving program, the insurance pays your inheritance tax bill, so there isn't a shock. And then Rachel Reeves' preferred option, aren't you all lucky? You have the opportunity to pay your inheritance tax bill over 10 years at a rate of interest, which, if you think you've got what she's saying is right, is currently 3.25% of interest. However, you won't get tax relief on that because that will be a personal charge. So again, even with that one, you're looking at, is it cheaper to borrow money, from the bank? So what can we actually do? So before, I think, January 2025, there's still a lot that we can and should be doing. And one of those, the first bit of that, is just add up your assets. I know from experience as an accountant that what actually should be quite simple is actually quite difficult. Actually, just listing out what you've got, what you bought them for, and at what cost. If you inherited them from the previous generation, what was the probate value, and what was the split of that probate value, and what was the dates. Update your fixed asset register. If you've got, is everything on there that should be on there, or is there things you've got on there that hasn't? Be careful of things like leased assets, where perhaps the equity value in that machine might be more than what your depreciated value might be. Once you've got all of those lists, you've got to go through and you've got to classify them between what's agricultural, what's business, what's residential, and what's net residential, just so you know what types of assets they are. Again, I know from experience, a lot of that will be on your balance sheet at historical cost values, so get either a current market value or at least a market appraisal on them. I think property valuers are going to be really, really busy in Q1 of next year. And also, if you're ring-fence some of your business into trading companies, even if those trading companies own some of these assets, just remember to just value those shares as well. Get an update on that. The second component is work out who owns what. Some of it might be in trust, some of it might be personal, some of them might be in limited company. So who and what owns each of those assets? Add that as a column. Look at your family members or other contacts. You know, who's going to be succeeding to these assets, and under what timescales are they going to be doing that, or you think you want them to do that. When you've got those two pieces of the jigsaw, you can then just butt them together and then go back to that sort of toolkit of different, trusts, lifetime giving, and I think the tailored plan is going to be a mix and match of each one, of those. Remember, we talked this morning's session about development opportunities. Inheritance tax is a death tax. So actually, if what you want to do is realise some development and take that profit out rather than roll it into something else, then there's no point locking that up somewhere. So do think about what you've got and what you want to do with that money as well. And finally, I think use your Ceres Rural, Ceres Property Advisor, because they will know you, they'll know your business, they'll know your assets, they'll know your risk profile, they'll know your likes and dislikes, and they can put all of that together, because tax advisors are brilliant. I have to say that, I am one. But they are only as good for the brainstorming as the information that they're given, and they can only really answer the questions that are put in front of them. So use your other sort of Ceres advisors to help you pose that questions and information. That was a very quick sort of run through. I'll hand you over to Michael Anderson, who will start expanding on these in more detail. Thank you.